BigBear.ai is currently trading at $7.21, down 3.22% for the day. While many investors are watching that intraday dip and focusing solely on the high-level AI narrative, they are missing a critical dynamic playing out just beneath the surface. The real story isn't just about winning the next big government contract. It's about the company's aggressive and frankly dilutive capital raising strategy that has fundamentally altered the shareholder structure in recent months. Most people see BBAI as a pure play on defense and AI, a smaller, more agile version of Palantir. They believe that its specialized platforms for decision intelligence give it a unique edge in a world increasingly reliant on data-driven warfare and logistics. The expectation is that as global tensions rise, the U.S. Department of Defense will open its coffers and a flood of contracts will send this stock soaring back to its 52-week high and beyond. That's the clean, simple story that gets repeated online. The reality, however, is far more complex and carries a significant amount of risk that the bullish narrative conveniently overlooks. The company's recent at-the-market offerings have introduced a substantial number of new shares into the float. While this raises necessary cash to fund operations and acquisitions, it also means that each existing share now represents a smaller piece of the company. This isn't a theoretical problem, it's a direct headwind against share price appreciation. For the stock to double from here, the company's market capitalization has to do more than just double. It has to overcome the weight of all those newly issued shares. This dilution is a hidden tax on existing shareholders, and it's happening at a time when the company is still not consistently profitable. The expectation of massive contract wins is being pitted against the reality of a growing share count and persistent cash burn. Looking at the intraday chart, we see the stock opened at $7.37, pushed to a high of $7.50, but was then sold off, hitting a low of $7.16. This isn't just random market noise. It reflects the ongoing battle between buyers captivated by the AI story and sellers who are looking at the financial statements and the broader market pressures. The trading volume today is moderate, but it's the character of the trading that matters. The failure to hold the morning high suggests a lack of conviction from buyers, allowing sellers to easily push the price back down. This pattern isn't new. Over the past few weeks, BBAI has been caught in a choppy range, sensitive to both sector-specific news and macroeconomic data. When a competitor announces a contract win, or when inflation data comes in hot, BBAI shares react, often with amplified volatility due to its lower market capitalization and high retail investor interest. Institutional ownership is present, but not dominant, leaving the stock susceptible to swings based on sentiment found on platforms like X and Reddit. These forums are filled with discussions about the company's potential, often focusing on its pro-model and savant platforms, but rarely do they engage with the less exciting realities of its balance sheet or the lengthy, bureaucratic sales cycles associated with government contracting. The company's last earnings report was a perfect example of this disconnect. While revenue showed growth, it was accompanied by widening losses. The forward guidance was hopeful, but laced with cautionary language about the timing and certainty of future government awards. The market's reaction was lukewarm, because the numbers didn't quite live up to the grand vision. The expectation of explosive, exponential growth clashed with the reality of a slow, lumpy, and expensive business model. Now, let's address a critical factor that many investors are either unaware of or choose to ignore: the significant short interest in BigBear.ai. This isn't a stock that is simply being overlooked, it's one that a notable portion of the market is actively betting against. The current short interest as a percentage of the float is elevated, indicating that a substantial number of shares have been borrowed and sold by traders who expect the price to fall. Their thesis likely centers on a few key points: a belief that the company's valuation is stretched relative to its current revenue and profitability, concerns about the ongoing share dilution, and the intense competition from both larger established defense contractors and other specialized AI firms. To understand this better, we need to look at the cost to borrow shares. When the fee to borrow a stock is high, it signals strong demand from short sellers. For BBAI, these rates have been volatile, spiking around key events like earnings announcements or major contract news. A rising borrow rate can sometimes be a precursor to a short squeeze, but it's more often an indicator of deep-seated bearish conviction.
What can you as an investor do with this information? First, you need to know where to find it. Data on short interest is publicly available from sources like the FINRA website, though it's often on a delayed basis. More timely, granular data can be found on platforms like Fintel or Ortex, which track daily short volume and borrow fee rates. Looking at the days to cover metric is also essential. This tells you how many days of average trading volume it would take for all short sellers to buy back their shares. A high days to cover ratio can mean that if good news hits, the rush for the exits from short sellers could create a powerful upward spiral in the stock price. However, it's a double-edged sword. It also means shorts are dug in, confident in their position. Do you think the current short interest in BBAI represents smart money identifying fundamental weaknesses? Or is it an overzealous bet against a promising technology? It's crucial to analyze the short thesis on its own merits. Are there concerns about the company's debt load valid? Is the competition from companies like Palantir truly a threat to BBAI's niche? Ignoring the reasons why traders are betting against the stock is a recipe for disaster. At its core, BigBear.ai Holdings Inc. operates in the decision intelligence space. They build predictive and prescriptive analytic solutions using artificial intelligence and machine learning. Their primary customers are within the U.S. federal government, including the Department of Defense and the intelligence community. Their technology is designed to help these complex organizations make better, faster decisions by analyzing vast amounts of data to identify patterns, model future scenarios, and optimize outcomes. For example, their platform might be used to predict an adversary's next move, optimize military supply chains, or forecast maintenance needs for a fleet of aircraft. They also have a growing commercial segment, but the government contracts remain the primary driver of their business and, consequently, their stock's narrative. The company itself was formed through a merger with a special purpose acquisition company, or SPAC, which is a history that often comes with baggage, including shareholder structures and initial valuations that can take time to normalize. Looking ahead, the future of BigBear.ai is a landscape of significant opportunity fraught with equally significant risk. The bullish catalyst is clear: the award of a major multi-year government contract. An award from a program like the Air Force's Advanced Battle Management System, ABMS, or a significant intelligence agency contract would serve as powerful validation of their technology and provide a stable, long-term revenue stream. This is the event that many long-term holders are waiting for, the ultimate fulfillment of the expectation. Another potential positive is the successful expansion into the commercial sector, diversifying their revenue and reducing their reliance on the unpredictable whims of government budgets. If they can prove that their decision intelligence tools are as valuable to a Fortune 500 company's supply chain as they are to a military operation, their total addressable market would immensely. However, the bearish scenario, the reality check, is just as plausible. The primary risk is competition. BBAI is not operating in a vacuum. It competes with giants like Palantir, Leidos, and Booz Allen Hamilton, all of whom have deeper pockets, longer track records, and more extensive relationships within the government. There are also numerous smaller, venture-backed AI startups vying for the same contracts. The risk is that BBAI gets caught in the middle, not big enough to win the massive prime contracts, and not agile enough to outmaneuver the startups. Furthermore, the risk of continued dilution cannot be understated. If the company continues to burn cash and finances its operations by selling more stock, it will place a perpetual ceiling on the share price, frustrating even the most patient investors. Comment below on what you believe is the single biggest factor that will determine BigBear.ai's success over the next 2 years: winning a landmark contract or achieving operational profitability. In summary, the story of BigBear.ai is a classic case of a compelling narrative running headfirst into a challenging operational and financial reality. The expectation is for a disruptive AI powerhouse that will become a cornerstone of national security. The reality is a company that is still fighting for profitability, navigating intense competition, and relying on capital markets to fund its growth to the detriment of its existing shareholders. The elevated short interest is a testament to this tension, a clear signal that the market is deeply divided on the company's future.
While a major contract win could certainly change the equation and punish the shorts, the underlying fundamental hurdles will remain. The path forward is not guaranteed, and investors must weigh the allure of the high-tech, high-growth story against the sober reality of the numbers on the page.